Good afternoon and happy Friday, and welcome back to the weekly market analysis for the week ending February 9th, 2024. And what we're asking today is, what's going to stop this market? I mean, can anything at this point stop this market? The Fed last week couldn't, and it doesn't seem like anything is. I mean, this market looks unstoppable at this point. So we'll take a look at what's the likelihood over the next week as well as over the medium term. But before we jump into it, I want to remind you to hit the like button and subscribe to the channel. And you can also find me at Mr. J. Thomason on Twitter. And you can follow my free weekly newsletter at befinanciallyfree.substack.com. In 2024, all subscriptions, whether paid or free, get to look at the entire newsletter absolutely free. And what's really helpful to know is when you watch these videos on Fridays, I tend to give you my gut reaction to the market action for the week. But in my newsletter, I give you, I really take time to dive in, and I come out with much more extensive analysis, and I give you things like this, where, for example, I said last Sunday that the most likely direction for risk assets was uncertain with an upside bias. So I like to share probabilities, direction and probabilities, not price targets, but direction and probabilities. So uncertain means that it's a middling probability, and then upside bias is showing you direction. And I have been for many weeks, on most weeks, I have been pretty good at kind of giving a sense of the likely direction and the probability of such direction. And then obviously in the outlook section, I share my reasons to be bullish and reasons to be bearish. So even if you have just a few minutes, you're able to see in just a few paragraphs the summary of the research that is done all the time on a regular interval, and what a research process looks like and the results that it shares with you. So if that's something you're interested in, by all means, please subscribe. The links to all of those things are in the description of the video below. So taking a look at the S&P 500 here through the futures market, which is the way that the lens through which I choose to view basically most markets. I've got the S&P 500, and obviously since the end of October, it's just been an unbelievable tear. If you go to the weekly chart, we've had essentially all but one of the last, I don't even remember how many candles this is. I think this will help me to see. The last 13 out of the last 14 weekly candles have been green. I believe this is the longest such streak in like 50 years, which is remarkable. And it's interesting from a sentiment standpoint. We're starting to get really, really frothy. People are starting to talk about the markets never going down again. I always make this joke on Twitter that red days are banned. I mean, if you think about it, we haven't had very many of them, relatively speaking, and only on a few occasions have we had more than one red day in a row. So we had, I think, 5 red days in a row at the end of December and into January, and then 2 red days in a row in mid-January. And basically outside of that, we have not had 2 days in a row where there has been where it's been red. So that's pretty amazing, honestly. So what's the likelihood that this continues in the near term and in the medium term? So if we just get our bearings here, on the S&P futures, we're at 50.44 to close. NASDAQ futures closing at 18.039 and 25 cents. Russell closing at 2019.1, which is still below its most recent swing high, but it is slightly above the prior resistance level that I've kind of just left from the last few years. Probably could actually raise that up a little bit. I'll just do that right here. If you go off of that, then obviously we're still below. Let's see here, get that a little bit more precise. We're still below resistance, just barely. So we'll see going into next week if this has any bearing. But obviously 2 strong days to finish the week in the Russell. Dow, we don't usually look too much at the Dow. Dow is down today, which is kind of interesting to note. But that's where equities are at right now. So just from just kind of looking at what's going on here, you can see I've expanded the chart now to include the MACD and the RSI. We are on overbought on the RSI. We are over 70. That's not quite as reliable a reversal signal as an RSI oversold signal, but that is something that we want to take note of, because when the RSI is overbought, it's a signal that the risk to reward of going long at this particular juncture is not super good. One of the things that I want to point out specifically is I'm just going to look at the MACD by itself, but you can kind of see the signal lines are pretty high up. It's been a while, since August of 22, that we've had signal lines that were up as high as they were, at the end of December. It's only happened a few times. Of note, though, one of those times was in June following the March collapse. So you have to always take things with a grain of salt and always understand that just because it might have behaved one way in one circumstance doesn't mean it's going to behave that same way in another circumstance. But what I do want to point out is the continued divergence that is playing out. So in this case, what you find is we've got the histogram. I've talked about this before, the histogram, and then of course the signal lines themselves. These are providing an interesting signal right now, because we have right now a triple divergence that is playing out on the histogram. So when you've got higher highs in price but then lower highs in the histogram, that's a divergence, right? So we're on basically the third divergence. But then also interestingly, you see that we've got the lower high right here, the lower high on the signal lines as well, right? So usually that's a sign, when you've got both signals confirming that divergence, that you're usually not too far away from some kind of price action in the opposite direction. Now that remains to be seen. I thought we might get that back at the end of January, on Wednesday the 31st, which was the Fed day. I thought that was kind of going to be the beginning of it, but that's obviously not played out the way that I thought it would. So still waiting. This still technically has a little bit more room to go to the upside before this thing turns over. Obviously, over the last week, the big development in the S&P has been finally getting over 5K, not just on the futures, but if you go to SPX, we even opened today, we gapped up and opened above 5,000 for the first time ever on the S&P 500. It is really interesting. I saw this article that talked about how going from the S&P moving from 4,800 to 4,900 took something like 700 days, and then only a week or maybe 2 weeks for price to go from 4,900 to 5,000. It's just really, really wild. What's the likelihood that this continues? Right, I talked about that divergence. You still have an RSI, like a third in a row RSI divergence at an overbought level, which I think is concerning. So you've got both the MACD histogram, the MACD signal lines, and the RSI showing you a triple divergence with price making higher high, but the indicators making lower highs, and obviously the RSI overbought signal as well. So you're stacking technical indicators that are suggesting that price is due for a pullback of some sort, and then of course price being so far away from the tide line here, it's not usually sustainable over a period of time. The last time, like I said, the last time we touched the tide line was back on November 10th, and usually we don't go more than 2 or 3 months without at least touching the tide line again. Doesn't mean that price is going to crash, but at least on the S&P, if you're starting from our close today to the top of the tide line, let's see here, you're getting about a 4.5% drop before you touch the tide line, and you'd still be super, super bullish even if that did happen. But I just think everybody should be aware of that possibility. What else might go into this? So if we look at the VIX is, let me get rid of the tide really quick, get rid of this. VIX closing once again below 13. Volatility has just been bleeding for a couple of weeks now, despite some small spikes periodically. There is no bid under volatility. You can see in the dispersion chart. This is, by the way, a relatively new offering as far as on TradingView is concerned. The DSPX, it's a dispersion indicator. Obviously, people have been making a big deal out of the dispersion trade, and dispersion is relatively in line in comparison with the last few years. So that's kind of interesting to note that that's what everybody has been talking about. But I don't think it's really any big deal right now. Let me kind of go over a few things that I'm concerned about. I'm not saying I'm uber bearish or anything. It's more just something to take note of. I'm here looking at the dollar chart. What I'm a little concerned about is that the dollar momentum you can see on the tide line here. The tide is bearish, with the red flag means that we are currently in bearish tide. But the green color on the tide indicator suggests that the bearish momentum is really, really weak. And so we're in prime position for this trend to change. So right now, this is one of those precarious situations where the tide indicator, well, according to the normal like tide strategy, this spot is a great spot to try to go dollar short, because this is the point where the greatest risk to reward is, right? So in this case, like, you would cut your dollar shorts if the DXY went higher than that, but you've got clear potential downside, and if this thing were to continue and make a lower low. So that's why that's one reason why the tide indicator is so helpful, because usually price coming below the tide line, above the tide line and above the control line when there's bearish tide, is the prime risk to reward moment for taking shorts. But the problem here is that because the tide line is green, it means that we are at the greatest risk of trend change. And so I'm a little concerned that over the next week, if we maybe the next 2 weeks, I would say, because sometimes this takes a little while to play out, that if we maintain enough dollar strength, if the dollar just kind of moves sideways to slightly up, then we might get a tide cross. Tide crosses are not generally good for risk assets. So we had a tide cross back in September, early September, and as you know, price on equities went down from in September and in October, right? And you actually can see the dollar couldn't make a higher high at the end of October and early November, and then it started to turn, right? And then you saw as the tide changes color to red and shows that the bullish tide momentum is weakening, that was where we obviously started to get that huge rip up in equities. But if you want to go back to starting in late 2021 and then going into 2022, dollar trending strongly bullish was really bad for risk assets, right? So I think that's something that concerns me. Maybe not immediately over the next week, but definitely over the medium term, over the next maybe 1 to 3 months, depending on how things go. The other thing I wanted to point out here was the 10-year yield, and I could show you another yield too in just a moment. But I'm really concerned that we're taking for granted where yields are at right now. Because right now price is on the other side of the tide and control line. And I've been talking for the last couple of weeks about how this bearish tide cross on the 10-year is shaky at best, because we've already had this happen 2 times before. This happened back in May of 2023 where we had a tide cross to the bearish side, and then it recrossed to the bullish side. And then of course, just like with the DXY, the fact that it might cross is not necessarily immediately worrisome, because like if you look over here, we crossed in May 2023. We didn't top in the markets until the end of July, right? So yields went up a little bit over those couple of months. It wasn't until the momentum started to accelerate to the upside where it started to become problematic for risk assets. But we saw that in May of 2023 when the tide crossed negative or crossed bearish and then crossed bullish again. There was no staying power there. We saw the same kind of thing happen back in August and September of 2021, right? And this was back when even myself, I misunderstood the situation, and I was like, well, there's no way yields are going to go higher than 2%. And then we got the tide cross here. You can actually see the tide crossed, and then we recrossed bullish, and I mean, you guys know what happened after that. It was just really crazy movement in the yield, and so I'm really concerned about this. If you have a bullish bias, this ought to be on your radar, because if price goes higher and drags that tide line up and we get a tide cross, then I'm concerned that we could see 5% yields again potentially. That would be my guess, and probably more likely 5.2 to 5.4% yields is kind of where I'm thinking that could go. Now, I'm not predicting that this is all going to transpire that way, but if you just think about the last 2 times that we had this happen, if you go from the last, from September 21 bullish tide cross to the peak, we got, it moved up almost 3% in the yield, right? And then when you go to the next tide cross, it moved, what is this? It moved almost 1.5% in yield. So I already, pardon me, I already lost track of what the change was. So basically, like, the first move was about 3%, the second move was about 1.5%. So if we're going to say that maybe, I mean, even at the very least, about 75 basis points, so 0.75%. If we go up 0.75%, we're at 4.94-ish, right? Something like that, 4.9, 4.95% on the 10-year. I mean, like, risk assets were puking basically from, the beginning of August 2023, which was, yields were at barely above where they're at now. They were puking all the way while yields were going up, to close to 5%. So that could be super detrimental, right? You could look at it a different way. If we get an average of the 2 moves, so what's the average between 1.5% and 3%? Well, that's 2.25. So if we go up 2.25, which again, I'm not saying this would happen, but 2.25 puts this thing up, what is that? Up to 6.4% almost, right? I'm not saying that's going to happen, but could you imagine what would happen in that case? I mean, we would have, I would guess, we would have assets would puke, we would have banking issues or something like that. So the question to me is, and again, this is all contingent on getting a tide cross. So please don't go out and think that what I'm saying is, oh, this is going to happen and it's inevitable and that this is my base case. I'm saying if we do indeed get a tide cross and it holds, the risk is that, at the very least, that we see over, 4.75. That's going to be the minimum target of the movement in yields, and I think that that's worth considering, because if that happens, risk assets. I mean, it's not that risk assets can't still go up with higher yields, because I mean, look at where we are, and we're making all-time highs, right? I mean, we weren't this high on yields back in where is it? Let's see, December 2021, January 2022, right? We're 3.5% higher on the 10-year, and risk assets are at all-time highs. So I'm not saying that at least for a while risk assets can't go up. I'm just concerned that right now, like, everyone, I think, to me, the most consensus thing that I've seen from most people is that the peak in yields is behind us. Everyone thinks that this is it. Everyone thinks it's over there. Well, the risk is that it's not. And I don't think that people are prepared for that risk. So that's going to be something that I'm watching for, not over the next week, but over the next maybe 3 months, 1 to 3 months or so. So again, if we get the tide cross, that's going to be a signal to start watching for the next 1 to 3 months where the yield is going to go. And again, like, even a tide cross doesn't guarantee it's going to go up. It could, I mean, just like here, the tide is crossing down and then is risking crossing back up. We could get a false cross. It could cross back up and then end up falling again. But I'm just saying, I don't think investors are prepared for that. for the possibility that yields do indeed go up that high. And one of the things I've been talking about quite a bit, if I can go down to my flows chart, is with the most recently updated flows from the end of January. I mean, just look. I mean, from January, the equity flows are down, and the bond flows are just through the roof, right? And this to me it's the exact same thing that happened last year, where everyone was positioned for the recession trade, everyone's positioned for bonds to outperform, equities to underperform, and so I don't think anybody thinks that bonds are going to go down. I don't think anybody thinks that yields are going to go like much higher from where they're currently at. I think the setup is really, really bad for people who are maybe thinking that yields are going to continue to go down. And the evidences of that is already starting in the 30-year. The 30-year has already recovered enough to get another bullish tide cross, right? And this one didn't even cross bearish back during the time that the 10-year did, right? The 10-year crossed bearish in May of 2023. The 30-year didn't, right? So it's been a long time since we had a bearish tide cross. That was back in July 2021, and we crossed bullish again in January 2022, right? And of course, that was the beginning of the big bond bear market, and the equity bear market too. So the 30-year has already crossed. It looks like the 20-year is in the same place almost that the 10-year is in, right? And that's going to be concerning, right? So I talk about that extensively because I think it's a really, really important risk to consider, and I don't think anybody is. Okay, so those are some more medium-term things. What about in the short term? In the short term, right now, the risk indicators are looking pretty good, at least in terms of the VVIX to VIX, still pretty strong. So that's pretty supportive of risk assets. High beta, low beta is still positive, so that's pretty supportive of risk assets as well. And then I wanted to look at breadth. It's interesting to me that the breadth on the S&P 500, despite moving to all-time highs, has not really improved. In fact, on the weekly chart, it's down. So I think that's something interesting. I'm going to get rid of my tide indicator for just a moment. That's the stocks above the 50-day moving average. Above the 200-day moving average, this is actually, it's still holding at relatively high levels, but it's down. And again, it's just so interesting that the stock market, the index is moving up, yet the number of stocks that are going up is actually going down. Right? Let's look at the NASDAQ. NASDAQ breadth, same thing, same story. It's actually going down despite the fact that the index is going up, right? So I find that that's all really interesting, right? And then what I've noticed too is on the NASDAQ, or actually no, I'm sorry, that was a different comment that I was going to leave for another time. So right now the breadth is not super supportive. I mean, right now, it's as long as it's above the 50 level, which is the level that as long as the equity breadth is above the 50 level, that's kind of the important level, then it's generally okay. But the problem is that it's deteriorating despite the S&P 500 and the NASDAQ going up as an index. So I think that's concerning. So there's divergence there. I'm a little concerned about the Dow diverging to the downside, despite the fact that the other equity indices are up. So that's a little concerning. If I go back to my charts here, AAII sentiment is still really, really high. Oh, I'm sorry, this is not an updated chart. I don't know what's wrong. Oh, sorry about that. I'm going to have to check my data sheets to see what's going on there. I apologize for that. I don't have the updated chart ready, but the breadth, the sentiment is still pretty high, pretty strongly bullish. And so that is supportive of the fact that there might be more of a near-term pullback at hand. So I think in the near term, my current assessment is that the My current assessment is that the technical indicators are supportive of a correction or at least a pullback, but there's no confirmation yet. And that's, I think, the key idea. We're not seeing any real confirmation yet. Over the next week, and this is the last thing I'll say before I wrap up, over the next week, I think we have an interesting couple of catalysts. Because today we just got the CPI revisions, which I think a lot of people were expecting it to be fireworks, and I wasn't. And to me, it didn't turn out to be anything important. But next week we do have CPI on Tuesday, and I think the market is expecting CPI to be lower. So we're expecting more Goldilocks. We're expecting more growth up, inflation down. And that has been largely what has sustained the market all across 2023, but then definitely, especially since the beginning of November. And what I'm wondering is, what if we get Goldilocks data and the market closes down? That would be a classic news failure. That would be an indication that that we're getting exhausted. So that could be a confirmation. And then also at the end of the week, we have options expiry, which is often a time where the market can get unpinned. And so that's something that could also be a catalyst for potentially a market reversal or a market change. And I don't mean reversal like it's going to crash, but just for some cool off. I guess conversely, on the other side, you've got CNBC anchors talking about how bearish they are and how like there's no way that this price action can be sustained, and you have to contrast that with some people who are on Twitter and other like podcasts and things like that who are talking about how this market can't be stopped and that we're basically going to go to 5,100 right away. And so, I mean, we're already almost halfway there. That's pretty crazy. But you have to kind of balance those things out. So whatever the case may be, it appears that for now the momentum is still strong enough that the price action can continue more to the upside. However, I would be cautious. And if you're not in the market already, if you're not in, for example, if you're not in equities already, then now is not the time to get long. You might have to wait, and this thing may run. Who knows? This is something you have to understand. This thing may run to 5,200. I'm not saying it will, but it could. And it still is not good risk management to try to buy it with that expectation. The technicals are overloaded. The breadth is deteriorating. And there are news catalysts next week which could lead to a decline. There's all the ingredients for something to change, and the risk to reward is not good here. So you might have to be patient. You might have to let it run for a little bit and then let it pull back, and then it's on that pullback that you would, as long as everything still lines up well, you would want to go long at that spot. But risk management here, there are other investable assets that you could go after. It's not just about equities. Obviously, like one of the things that's been going pretty wild, it just changed, but one of the things that's been going pretty wild is Bitcoin the last couple of days. Bitcoin just made a new closing high, both on the futures and on the TradingView all-time history chart. So that's obviously a trade that you could take. That's positive. A lot of people wondering if crude oil has bottomed and is finding a base here. You can see we've got consecutive higher lows, and now the goal will be to try to make a higher high above 70. What is this? About 79 or 80. So there's a whole bunch of different assets that you can go into. You don't have to be so quick to try to rush into equities, even though that seems to be what everyone's always the most interested in. Keep your opportunities open. Don't waste your capital chasing something that where there's no good risk to reward. Save your capital for when you actually have a clear edge. And that's where I'll leave you for today. Thanks again for watching. See you guys next time.